10:30 a.m. EST, March 14th. COMEX, Silver Futures Desk, New York, major U.S. bullion dealer sites nationwide. COMEX screen shows silver futures at $26.80, steady, unremarkable, holding in a tight range. Pull up any major U.S. dealer site right now, search for 1,000-ounce bars, click Buy Now. Watch what happens. Physical silver is trading at $78 per ounce. That's not a typo. $78, a $51.20 gap, 191% premium over COMEX paper. Refresh the largest dealer inventories, out of stock, stamped across every 1,000-ounce bar listing. American Eagle coins, back ordered 8 weeks, premium spiking 20-25% over already elevated spot. COMEX bid-ask spread widening to $4.20, 15 times normal width. While electronic futures contracts trade smoothly on screens, actual metal has vanished from U.S. dealer shelves. One major retailer posted at 10:27 a.m. Due to unprecedented demand, all large bar inventory depleted. Allocation basis only, no pricing guarantees. This isn't volatility anymore. This is systemic failure, and it's just getting started. By 10:45 a.m. Eastern, the magnitude of the disconnect became impossible to ignore. COMEX futures held in the 26 to 27 range, volume elevated but orderly, showing no signs of panic. Toggle to physical dealer quotes. Lowest available price for immediate delivery on 1,000-ounce bars was $76. Highest quote reached $82 depending on dealer and delivery timeline. That's a $49-$55 premium over COMEX, a 183 to 204% gap. In a rational market, arbitrageurs should be executing the most obvious trade in history: buy COMEX at $27, take delivery of physical, sell to dealers at $78, pocket $51 per ounce. The profit margin is so extreme it should be self-executing within minutes, yet it's not happening. Why? Because COMEX can't deliver physical metal in the quantities and timeframes required. One Chicago arbitrage desk reported, "We bought 500 contracts, 2.5 million ounces, planning to take delivery and sell physical. COMEX delivery timeline, 4-6 weeks, subject to availability. Physical buyers want metal now. We can't bridge the gap." The arbitrage mechanism connecting paper and physical markets just failed completely. Paper traders thought they were hedged with futures contracts. Now they're trapped in positions that can't convert to the physical metal trading at triple the price. Historical context made the current crisis even more alarming. In 1980, the Hunt brothers drove silver to $50 before COMEX changed margin rules to kill the rally. In 2011, silver hit $49.82 before 5 consecutive margin hikes in 9 days crushed momentum. Those were regulatory interventions, exchange rule changes designed to stop price runs and protect shorts. This situation? Fundamentally different. COMEX hadn't changed margin requirements. No emergency measures had been announced. The rules remained constant, yet the premium kept exploding. By 11 a.m., physical dealers were quoting $79.84, depending on product type, while COMEX sat at $27.20. One veteran precious metals trader noted, "In 80 and 11, they changed the rules to stop the squeeze. Today, the squeeze is happening despite the rules. That means the problem isn't speculative excess. It's actual physical shortage. You can't regulatory engineer metal into existence." The system wasn't being manipulated this time. It was being exposed. Decades of fractional reserve precious metals markets, where exchanges sold paper claims against the same ounces dozens of times over, were colliding with sudden physical demand. The promises were meeting reality, and reality doesn't honor contract language. U.S. dealer inventories painted a picture of total depletion. Major online bullion retailers, 1,000-ounce bars showing sold out or pre-order only with no delivery dates. 100-ounce bars back-ordered 6 to 10 weeks. 1-ounce rounds and coins available only at premiums of $12, $18 over COMEX spot. One major dealer's site updated at 11:10 a.m. All serialized bar inventory exhausted. Custom orders require 50% non-refundable deposit, delivery unconfirmed, pricing subject to daily adjustment. Translation: we'll take your money for metal we don't have, can't promise we'll get it, and might charge you more later. Meanwhile, COMEX open interest remained at 185,000 contracts, 925 million ounces of paper claims. COMEX registered inventory available for immediate delivery, 48,000 ounces. The ratio, 19,270 paper claims per deliverable ounce. One Florida dealer reported I have clients offering $85 cash for 1,000 ounce bars, no questions, immediate pickup. I have zero inventory to sell them. Screen shows COMEX at $27. Physical reality shows dealers at $80. If you own a silver ETF, a futures contract, or an unallocated account, you hold a claim on $27 metal. If you try to convert to physical, you're paying $80. The $53 difference is what you pay to discover your paper isn't backed by metal. By 11:15 a.m., the global dimension of the crisis emerged. Shanghai Gold Exchange opened its afternoon session with silver premium quotes at $82 over COMEX equivalent pricing. London spot market showed physical delivery premiums of $58. New York dealers quoting $78.84. The premium wasn't isolated to one geography, it was global. But here's the critical detail. COMEX still showed $27.40. The world's supposedly authoritative price discovery mechanism was reporting a price 66% below where actual metal traded. One London vault operator explained, COMEX pricing reflects the cost of a paper promise, physical pricing reflects the cost of actual metal. Those used to be the same thing because paper could convert to physical. That conversion broke. Now they're different assets. Western paper markets relied on the assumption that Asian physical supply could always be arbitraged back if needed. That assumption just shattered. Shanghai physical wasn't flowing west. London allocated metal wasn't flowing to New York. Dealers who'd sold forward at COMEX prices couldn't source metal to deliver. One Singapore dealer reported, I'm getting calls from U.S. dealers offering $5, $7 per ounce premiums if I can ship 100,000 ounces to New York within 2 weeks. I can't source that quantity at any price that makes the economics work. The global physical market had bifurcated from the paper market, and the gap was widening by the hour. The lease rate explosion exposed the hidden stress in the system. Silver lease rates, the cost to borrow physical metal for delivery obligations or short covering, spiked to 18% annualized by 11:45 a.m. Eastern. Normal lease rate, 0.4, 0.6%. An 18% lease rate means physical silver is virtually unborrowable at any economically viable cost. One major bank's commodities desk reported, we have short positions we need to cover. Normally we'd borrow metal, buy it back over time, return it to the lender. At 18% lease rates, that's economically impossible. We're forced into immediate cash settlement at whatever price physical trades, which is $80, not the $27 COMEX shows. Short sellers who'd been betting on lower prices faced catastrophic losses. They'd sold at $30 expecting to buy back at $25. Now they're being forced to settle at $80. The math? Sell 100,000 ounces at $30, or $3 million revenue. Buy back at $80 to settle, or $8 million cost. Net loss, $5 million on a position that looked profitable on paper. Industrial users faced similar crises. Electronics manufacturers who'd sold forward production based on $28 silver input costs now faced $80 spot prices for physical delivery. One solar panel manufacturer in Arizona reported, our input cost models assume $30 silver. At $80, our margins go negative. We either halt production or sell panels at a loss. The lease rate spike wasn't a technical signal anymore. It was proof the physical metal didn't exist in available form. While COMEX maintained surface calm, physical markets showed panic. COMEX futures traded in a $26.80, $28.60 range through midday. Less than 7% intraday volatility. Paper market participants watching only electronic screens would see elevated but manageable price action. Switch to physical dealer sites. Prices range from $76 to $89 depending on product, quantity, and delivery timeline. That's a $13 range on top of a 50-plus premium over paper. One Texas dealer updated pricing 3 times between 11:30 a.m. and 12:15 p.m., each update raising quotes by 2 TASA forwarders. Their site disclaimer read, prices valid for 15 minutes only, market conditions extreme, phone orders only. The dual reality was complete. COMEX paper traded with apparent liquidity and modest volatility. Physical metal traded with zero liquidity and prices disconnected from any COMEX anchor. Which price is real? Both, for different assets. Paper silver is a derivative contract that promises future delivery or cash settlement. Physical silver is actual metal you can hold. They used to price identically because conversion between them was seamless. That conversion mechanism broke. Now paper trades at $27 as a contract, and physical trades at $80 as a commodity. One institutional trader explained it simply, it's like airline points versus cash. Points have a notional value, but try to convert 100,000 points to actual cash, and you'll discover the exchange rate is worse than advertised, or unavailable entirely. If you own paper silver, you own points. The cash is $80 metal you can't access. The supply-demand fundamentals made the shortage mathematically inevitable. Global silver mine production, 830 million ounces annually. Industrial consumption, 570 million ounces used in electronics, solar panels, EVs, medical equipment, water purification. Investment demand, 220 million ounces. Jewelry and silverware, 160 million ounces. Total demand, 950 million ounces against 830 million production. Annual deficit, 120 million ounces. That shortfall gets filled by above-ground stockpiles, recycling, and, critically, people holding paper claims who never take delivery. The fractional reserve system works until it doesn't. Now imagine a scenario where just 5% of paper holders demand physical delivery. That's 46 million ounces of delivery requests, 5% of 925 million ounces of COMEX open interest, hitting a market already running a 120 million ounce annual deficit. The math breaks immediately. One mining executive explained, "You can't print silver. You can't conjure it with monetary policy. We dig it out of the ground at 830 million ounces per year, and that number isn't increasing. It's been flat for a decade. Demand exceeds supply by 120 million annually. The only reason prices haven't exploded before now is because most silver ownership is paper that never converts to metal. The moment people try to convert en masse, they discover there isn't enough physical silver to honor all the paper promises. By 12:30 p.m., COMEX registered inventory had dropped to 44,000 ounces as holders withdrew to private vaults. Against 185,000 open contracts, that's a 21,022 to 1 ratio of paper claims to deliverable metal. Forced delivery mechanics created a cascade of failures. March COMEX contracts, expiring in 5 days, showed delivery requests for 9,100 contracts representing 45.5 million ounces. COMEX registered inventory, 44,000 ounces. Even if every ounce got delivered to March longs, that covers 0.096% of delivery requests. The remaining 99.9% gets cash settled. Here's the trap. COMEX rules specify cash settlement happens at COMEX prices, not physical market prices. COMEX shows $28. Physical markets show $81. Contract for 5,000 ounces expecting delivery, you get $140,000 cash settlement, 5,000 x 28. You go buy physical at $81 and need $405,000. You're $265,000 short. One hedge fund manager described it. We're being settled at imaginary paper prices for metal that trades 189% higher in physical form. It's forced liquidation at prices that don't reflect reality. But it gets worse. Every cash settlement creates immediate physical buy pressure. Settled longs rush to physical markets trying to actually acquire metal. That buying hits already depleted dealer inventory. Prices spike higher, the premium over COMEX widens further, more contracts get cash settled, more buying pressure emerges. It's a doom loop. One dealer reported at 12:45 p.m., "I've had 6 institutional buyers call in the past hour wanting to buy 50,000 plus ounces each. They just got cash settled on COMEX and need to convert to physical to meet obligations. I can't help them. The metal doesn't exist at quantities they need." The forced settlement mechanism designed to relieve delivery pressure was actually amplifying it by converting paper claims into desperate physical buyers. Gamma squeeze dynamics added systematic buying pressure. Silver options market showed massive open interest in call options at $35, $45, $60, and $75 strikes. As physical market prices pushed through these levels, even while COMEX paper stayed below 30, market makers who'd sold those calls faced delta hedging requirements. They'd sold options without owning underlying silver, assuming the strikes would stay out of the money. Now they were forced to hedge exposure by buying COMEX futures. Here's the mechanical cascade. Physical prices rise, calls go in the money based on physical reality. Market makers buy futures to hedge. Futures prices rise. More calls go in the money. More hedging required. More buying forced. One options desk reported at 1 p.m. "We have 20,000 contracts of $60 calls that are in the money based on physical market pricing. Each contract requires us to buy 5,000 ounces of futures to hedge. That's 100 million ounces of forced buying hitting COMEX. The open interest barely supports that volume." The pressure was algorithmic, mechanical, unavoidable. Market makers don't have discretion. Risk management systems force hedging regardless of market conditions. Short sellers compounded the problem. They'd sold futures expecting lower prices, now facing margin calls as COMEX prices crept higher, forced to buy back positions. One institutional short explained, "We sold at $30 targeting $25. Now COMEX is at $29 but physical is at $82. Do we cover at $29 and accept the loss, or wait and hope the gap closes? Every hour we wait, physical premiums increase and our exposure grows." The combination of forced option hedging and short covering created systematic buying pressure that couldn't be relieved because the physical metal to deliver against it didn't exist. Backwardation deepened to levels signaling immediate crisis. By 1:15 p.m. Eastern, COMEX silver futures showed severe inversion. March contracts at $29.80, June at $27.50, September at $26.20. That's backwardation, near contracts trading above distant contracts. The curve had inverted by $3.60 from front to back. Normal silver futures show contango, distant contracts trading higher due to storage and financing costs. Backwardation means the market is screaming for metal now, not later, and is willing to pay premiums for immediate delivery. The 18% backwardation between March and September reflected panic. One COMEX floor trader noted, "I've traded silver for 20 years. I've seen backwardation during supply disruptions. I've never seen it this deep, with physical premiums this extreme while registered inventory sits near record lows. This isn't a temporary dislocation. It's proof the delivery system is broken." Physical dealers confirmed the urgency. Quotes for silver with 2-week delivery, $79. 4-week delivery, $76. 8-week delivery, nobody was quoting because nobody could guarantee they'd source metal that far out. One Denver dealer explained, "Buyers are paying higher prices for faster delivery because they don't trust that metal will be available later. When people pay premiums for immediacy despite knowing delayed delivery would be cheaper, that's fear. Fear the whole system collapses before they get their metal." The backwardation wasn't speculative positioning, it was physical buyers signaling they'd pay any premium to secure metal before dealer inventories hit absolute zero, and price became irrelevant because supply simply ceased to exist. Geopolitical factors closed the remaining pressure valves. At 1:30 p.m. Eastern, China's State Administration of Foreign Exchange issued guidance emphasizing strategic resource management and precious metals reserve optimization. Russia's central bank announced increased domestic silver purchases for strategic reserves. India raised import tariffs on silver from 12.5% to 20%. Simultaneously, 3 separate nations implementing policies that restricted silver exports or incentivized domestic retention. The global physical silver market depended on metal flowing from areas of surplus to areas of deficit. Cut those flows through policy intervention, and regional shortages become systemic. One geopolitical commodities analyst explained, "When multiple nations simultaneously move to secure silver reserves, it signals they expect monetary instability or industrial scarcity. Silver is unique. It's monetary metal and critical industrial input. They're not letting it leave their jurisdictions." The implications for COMEX were catastrophic. Western paper markets had always relied on the assumption that physical supply from Asia or other regions could be accessed to settle delivery requests. That assumption just died. COMEX registered inventory dropped another 8,000 ounces as international holders withdrew metal to sovereign-controlled vaults outside exchange jurisdiction. Remaining registered, 36,000 ounces. Open interest, 185,000 contracts. New ratio, 25,694 paper claims per deliverable ounce. The fractional reserve system was collapsing not just from demand pressure, but from supply being strategically sequestered by nation-states who understood the paper game was ending. Physical metal wasn't just scarce. It was being deliberately removed from the markets where paper promises needed it most. By 2 p.m. Eastern, the endgame was mathematically certain. U.S. dealer sites, 0 inventory of 1,000-ounce bars at any price, 0 inventory of 100-ounce bars from major mints, 1-ounce products showing 10, 14-week backlogs, COMEX futures, $30, $40. Physical dealer quotes for any available metal, $83, $89. The premium hit $50.60 to $58.60, 173 to 192% over paper. One major nationwide dealer posted, "Effective immediately, all online ordering suspended. Phone orders only, subject to availability verification. No price guarantees. Payment required before sourcing." That's dealer speak for, we're not sure we can get metal, so we need your money up front to find out. The inventory depletion was global. London vaults reporting drawdowns of 18 million ounces in 2 weeks. Shanghai inventories at multi-year lows. New York dealer networks completely exhausted. One vault operator stated plainly, clients are offering $95 per ounce for immediate allocated delivery. We don't have it. It's not in our vaults. It's not available from our suppliers. The metal either doesn't exist in deliverable form, or it's held by people who won't sell at current prices. Industrial users began securing direct contracts with mining companies, bypassing exchanges entirely. One automotive manufacturer signed a 3-year direct supply agreement with a Mexican mine, guaranteeing $68 per ounce regardless of spot prices. They're paying 124% premiums over current COMEX to guarantee future supply, proof they believe paper markets can't be trusted to deliver. The paper market was losing its function as a price discovery and delivery mechanism because it had lost connection to the physical commodity it supposedly represented. The final data point erased any doubt about systemic failure. March 14th, 3:00 p.m. EST market close. COMEX silver futures settled at $31.20. Physical dealer quotes closed with metal trading at $87, $92 for any bars available within 72 hours. The premium, $55.80 to $60.80 per ounce, a 179–195% gap. Through the final trading hour, the divergence didn't narrow, it widened. Physical premiums increased as dealers updated quotes to reflect total inventory depletion. Backwardation persisted. March at $31.20, September at $26.80, a 440 inversion. Lease rates closed at 17.2% annualized. Registered COMEX inventory, 36,000 ounces. Open interest, 183,000 contracts. Final ratio, 25,416 paper claims per deliverable ounce. One exchange official, speaking anonymously, stated, "We're watching a fractional reserve system realize it's fractional. The paper market made promises it can't keep. Physical holders understand that. They're charging premiums that reflect actual scarcity, not the contract abundance COMEX pricing suggests." The numbers to watch going forward: physical dealer quotes, now $87.92. COMEX paper price, now $31. Registered inventory, $36,000 OZ. Delivery requests, 45.5 million Oz for March alone. The gap between promised delivery and actual capability isn't closing, it's expanding exponentially. The system that was supposed to arbitrage away the price differences never showed up. Because it can't. The metal doesn't exist in deliverable form at the prices paper contracts claim. This isn't volatility. This is the moment a fractional reserve precious metal system collided with physical reality, and physical reality won. The squeeze is far from over. Watch for 90 Plauer's physical silver. This system can't hold much longer.